What if I told you that most traders use Fibonacci retracements wrong? Today, we're breaking down a powerful chart that transforms these classic levels from simple lines into a high-probability trading strategy. All right, so what we're looking at here is a classic framework used in technical trading, breaking down the Fibonacci retracement levels into actionable zones. The core idea is that after a strong price move, the market will often retrace or pull back a predictable percentage before continuing its trend. This chart flips the script a bit, telling us not just where price might go, but where the high-probability trade setups are. They've divided the pullback into clear tiers of probability. The nothing happens zone at the 0% level and the manipulated zone around the 50% level are where you typically want to avoid taking a position, as the price action is often messy and indecisive. The real sweet spot, labeled as the supply zone, with a very good probability, sits between the 78.6% and 88.6% retracement levels. This is where the chart suggests you should be looking for your best selling or shorting opportunities. Then, as a confirmation, the sell area and sell here markers at 78.6% and 88.6% act as your final triggers. Essentially, this isn't just a Fibonacci tool. It's a strategic map that teaches you to be patient and only place your trades where the mathematical odds are significantly in your favor. This chart distills the Fibonacci retracement tool into a straightforward, action-based trading guide. The core idea is that after a significant price move up or down, the market will often pull back or retrace before continuing its trend. This chart maps those pullback levels and tells you exactly what to do at each one. It starts at the top with the 100% level, representing the peak of the prior move. As price pulls back, it enters the high-probability sell here zone between the 78.6% and 88.6% retracement levels. This is identified as the prime area to look for selling or shorting opportunities. The middle of the chart, around the 50% level, is marked as manipulated, warning that price action here can be choppy and unreliable. Finally, a shallow pullback to the 38.2% level is considered a low probability zone for a strong reversal, and a 0% retracement, meaning the trend just continues with no pullback at all, is labeled nothing happen. In essence, this isn't just a set of levels. It's a strategic filter that forces you to wait for the highest probability trade setups, primarily focusing on the deep retracements between 78.6% and 88.6%. This chart gives us a brilliant and simple way to gauge the underlying strength of a trend using Fibonacci retracement levels. Instead of just predicting where price might reverse, it uses the depth of a pullback to diagnose the market's momentum. Think of it this way. A very strong, healthy trend doesn't give much ground to counter moves. So if a pullback only goes as deep as the 23.6% Fibonacci level before bouncing, this is a short pullback, signaling a strong trend. It shows buyers in an uptrend or sellers in a downtrend are aggressively stepping in early. Conversely, if the price retraces all the way to the 50% level, that's a medium pullback indicating a moderate trend. The battle between bulls and bears is more balanced. Finally, if the pullback is very deep, reaching the 78.6% level, this flags a weak trend. The trend might still be technically intact, but such a deep retracement shows significant weakness and a lack of conviction. In short, this tool flips Fibonacci from a purely predictive indicator into a diagnostic one, helping you decide whether to trust the trend's strength or prepare for a potential reversal. This chart provides the clearest possible breakdown of the two fundamental ways traders use Fibonacci tools, one for entry and one for exit. It separates the entire trading process into two distinct phases. The first phase is the retracement. This is used to find your entry point after a price swing. You draw the Fibonacci tool from the start, the swing low, to the finish, the swing high. As the price pulls back from that high, it will often find support at key Fibonacci levels like the 61.8% or 38.2%, giving you a high probability zone to enter your trade. Once you're in, you shift to the second tool, the extension. This is used to determine your profit target or where to exit. You draw the extension tool from the same start point through the retracement finish, and it projects where the next likely swing high could be, levels like the 127.2% or 161.8%. In essence, this chart gives you the ultimate trader's checklist. Use retracements to get into the market and use extensions to know when to get out with a profit. This chart introduces one of the most powerful concepts in Fibonacci trading, the golden zone. It simplifies the noise of multiple retracement levels by focusing on the single most critical area for a high-probability trade entry. The golden zone is defined as the price territory between the 50% and the 61.8% Fibonacci retracement levels. The logic behind this is profound. A 50% retracement represents a classic, balanced pullback, while the 61.8% level is the famous golden ratio. When price pulls back into this zone, it indicates a healthy correction that has shaken out weak hands without breaking the underlying trend. This creates a strong confluence area where you often find significant support in an uptrend or resistance in a downtrend. Instead of guessing at 7 different levels, this chart teaches you to be patient and focus your attention on this premium area where the battle between the trend and the counter trend is truly decided, offering the optimal balance of risk and reward. This chart provides a perfect real-world example of how to use Fibonacci retracements to time your entries in an uptrend. The key concept here is confluence. We see that the price, after making a swing high, pulled back. It didn't just stop at a random level. It found a clear floor exactly at the 50% Fibonacci retracement level. But here's the critical part. This bounce didn't happen in a vacuum. The chart points out that this 50% level coincided with a previous structure, which could be an old resistance level that has now turned into support or a significant swing low. When the Fibonacci level aligns with this existing technical structure, it creates a high-probability trade setup. It's the combination of these two factors, the mathematical Fibonacci level and the market's built-in memory of price action, that gives a trader like Josh the confidence to enter, expecting the underlying uptrend to resume. This chart is the complete game plan. It shows you how to build an entire trade from entry to exit using Fibonacci. Let's break it down. After an uptrend, you draw your Fibonacci retracement tool from the swing low, start, to the swing high, finish. As the price pulls back, you look for your entry level at a key retracement zone, like the 61.8% or 50% level, where buyers are expected to step in. Now, for the crucial risk management, your stop loss is placed strategically below the next retracement level down, which is the 78.6%. This level acts as a failure line. If price breaks below it, the pullback is likely turning into a full reversal. Finally, for your exit, you have profit targets. The first possible target is often the 38.2% or 23.6% level on the way back up. And a second possible target could be a full return to the start of the fib tool, or even beyond using extensions. In one image, this gives you the holy trinity of trading: where to get in, where to get out with a profit, and where to get out to protect your capital. This is a step-by-step flowchart on how to use Fibonacci retracements to find a strategic re-entry into a trend you've missed. Let's walk through the process. It starts with a common scenario. A strong bullish move has occurred, and you missed the initial entry. You're now waiting for a pullback to get in. The first step is to identify the initial ABC move, where A is the start of the move, B is the peak, and C is the pullback low. You then draw your Fibonacci retracement tool from point A, the low, to point B, the high, to see where the price is retracing. The chart then presents 2 smart ways to plan your re-entry. First, you can use pending orders at key Fibonacci levels like the 50% or 61.8% retracement, anticipating a bounce. The second, more conservative method is to wait for confirmation. You wait for price to actually bounce from a level and then start making a new higher high. Once this new official ABC pattern is confirmed, you redraw your Fibonacci tool using the new, more recent swing low. The first point C becomes your new point A, and the original high, point B, to find an even more precise entry point for the next leg up. In essence, this teaches a dynamic approach. Don't just draw your fib levels once and hope. Redraw them as the market creates new structure, allowing you to find high-probability re-entries and ride the trend multiple times.